The S&P is having a mixed day at the market open, but today our attention is on stocks that insiders have been selling and a significant amount. Now we're running it through a screener where, as you can see, we're looking at sales from insiders, and these are companies that are around 50 billion or larger, and we're talking about an amount of $2 million and over the last 7 days. So these are very, very recent. Now the first one that we are looking at today is Booking Holdings, where in fact we see the senior vice president as well as the chief accounting officer. And there you go, for the date 15th of August, so 4 days ago, sold around $3 million worth of shares. Now we're taking a look at each of these companies. We're going to look at their historical performance. We're going to talk about their dividend safety for those that pay a dividend, as well as run through some very important financial metrics to understand whether or not these are companies we should be worried about. We're going to put them all through our intrinsic value calculation, tell you what we believe the fair value to be, as well as what Wall Street are anticipating over the next 12 months. And in fact, alongside insiders, we should be selling these stocks as well. As we said, Booking Holdings, the first stock with a double buy and a hold from Quant. This is trading in the mid to upper end of the 52-week range. It does pay a yield. This is around 1%. And in terms of a forward P, it's around 21. Bear in mind, right now, the S&P sits at 23. Over the last year, it is up nearly 15%. Over the last 10 years, significant outperformance of the S&P, up 194. Now, in terms of this company, we're going to look at the metrics, but just understand no dividend safety score today, as they've just recently started paying a dividend. Hence why on the free cash flow payout, we only have the trailing 12 month at 8%, as well as the next 12 months at 17%. Now, given this is well below our 60% level we want to see as a maximum, we do expect moving forwards, Booking Holdings will start to increase that dividend at a very rapid rate. Now, in terms of the free cash flow, very important metric, consistent increases over the longer term. Something we pretty much get with this company, $53 in 2014, $194 in 2023. So pretty much 4 times growth over the last 10. Over the next 12 months, a small increase anticipated. And we do note the justifiable 2020 COVID year. No surprises, given a lot of people were not going out booking their holidays. Now, when we move on into the sales growth, as always, we want to see 3 to 7% growth year on year at a bare minimum for the more mature companies. What's very nice to note with this company, nearly double-digit growth every single year, 25 in the more recent, and that negative 55 drop in 2020. Again, no surprises whatsoever. Then from a numerical standpoint, we see nearly triple the top line, 8 billion in 2014, 21 in 2023, and even though they don't have a lot of shares outstanding, even 10 years ago at 53 million, they do some very nice share buybacks when they do believe the company is severely undervalued, and it now sits around 35 on a trailing 12-month basis. So something they do like to do on top of that new yield of around 1% they've just started in the last year. We then move on to the ROIC. As always, a minimum 10%. Give us faith that management are able to effectively allocate their capital. Looking very strong above that pretty much every year bar COVID. 47% in 2023, absolutely phenomenal, especially if they can keep this up moving forwards. And in terms of the margins, now you know on this channel, we want to see operating margin efficiency where it increases over the long term. Unfortunately, whilst it did look very good from 2014 to 2019, it did drop in the COVID year. It is now up to the mid to upper end of the 20s, which is very strong, granted that we do want to see a minimum of 12% on this point, but we want to see it up to the levels we have previously seen and increasing moving forwards. Free cash flow margin looking absolutely gorgeous in the 30s year on year, again bar that 2020 period, so no worries whatsoever. Let's hope they can keep that consistency. Then the net debt to EBITDA, remember, standing for the earnings before interest, tax, depreciation, amortization. Why we find this very important, where it correlates to dividend safety, balance sheet strength, and 0.31 is the number of years it would take Booking to pay off all of their debt net of cash on hand. Now look, we want to see below 3, so it is significantly better. 0.31 in 2023, 0.12 over the next 12 months, so phenomenal balance sheet, no worries. And even though we don't have a dividend safety score yet, we do believe this to not just to be very safe, but also increases at a very good rate moving forwards. Now our intrinsic value of $4,300, the way we got to this number is we ran it through the DCF model, and we can show you in today's episode. Effectively, we have the free cash flow year on year. Now the average growth will be skewed as it has gone from a negative to a positive, but what we are seeing here moving forwards, we've gone for a growth rate of 4%, which we do believe to be very conservative. In fact, we have a low medium rate, 2, 4, and 6. Now we'll show you the 4%. Using the discount rate of 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get that undervaluation signal, which effectively gives us 30% upside. Now, if you believe that is way too optimistic, well, at 2%, just for transparency, when we put it in the model, it gives us 3712, which, as we can see, still upside, but lower at 12%. And for the more optimistic among us, well, at 6%, we can see here just under $5,000, indicating 50% upside. Now, these numbers are very subjective, although we will take now the middle rate of 4%. But as always, you can click on the pinned comment below to grab a copy of this model and run your numbers through, whether it's for booking holdings or any others that you wish. So our intrinsic value of $4,300 is marginally higher than Wall Street of 4144, where they see upside of 25%. We always on this channel add a margin of safety at 10%. We execute on these if they meet our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Well, if you believe that, in today's episode, it is a buy at 3865, and then we keep going till it's near the current trading price. And in today's episode, it isn't at a 25% MOS just yet, but it sits somewhere between 20 to 25, with Wall Street indicating a nice buy with 25% over the year. Now, yes, insiders have been selling as we just ran through, and whilst we don't believe it to be a massively bearish signal, insiders do sell for reasons like personal and financial, and therefore it isn't one we would incorporate to suddenly sell a stock. However, when we have ran it through the intrinsic value calculation, we do believe it is undervalued. As we said, 20 to 25% MOS with 25% upside. As always though, do give us your thoughts as we go along these today. The next insider sell that we are going to be discussing is Palo Alto Networks, where in fact the CEO on the 13th, so we are talking about again just a few days ago, sold around $22 million worth of shares. Now that is significant. He is a CEO, so he does hold a very strong position. He will have a lot of data available to him that us as investors will not have. So let's take a quick look at this company. Now it is up very strongly, in fact 59% over the last year. Over the last 10 years, phenomenal performance, up 1,102%, so massive outperformance of the S&P. It is trading now at the mid to upper end of the 52-week range. One buy rating with a double hold. This one doesn't currently pay a dividend and does have a forward PE just below 60. Looking at their metrics, well, on a free cash flow basis, 23 cents in 2014, increased massively to 8.68 in 2023, a smaller increase anticipated over the next 12 months. So maybe not consistent increases, but over the longer term, some very, very strong numbers. And then when we look at the sales growth, double digit every single year, maybe there's an argument that it has started to slow down. 25 in 2023, 20% on a trailing 12-month basis, but nonetheless still looking very good. And when we do look at it from a numerical standpoint, 600 million in 2014, more than 10 times to 6.9 billion in 2023. Now, yes, they have diluted your position as a shareholder over the last 10 years, but do bear in mind, it isn't a large amount, and when you do factor in your share price return of over 1,000%, you probably wouldn't care about this minimal dilution. We then move on to the ROIC. Now remember, 10% or more, what this actually shows us is that 9 of the last 10 years, they did not turn a profit, 9% in 2023, so that was the first year. And when we do look at the margin, again, this does in fact reinforce that with negative margin until 2023. Nice to see, trailing 12-month basis at 11% is towards that 16 that we do want to target. And free cash flow margin, very impressive from 2015 in the 30s to 40 regions year on year. So we do love to see that, makes it very attractive to consider. And also the net debt to EBITDA effectively in 2023 at 0 and over the next 12 months, meaning it won't even take Palo Alto Networks one day to pay off all of their debt net of cash on hand. We then get to our intrinsic value at $384. Now how we got this, again, this one we just used the DCF model. Remember, they don't pay a dividend, and we use a 16% growth rate moving forwards, which we here have as a medium rate, low at 14, high at 18. You can see those upsides depending on the figures used, and we thought this was fairly reasonable, not just below the average of 87, but also below the average of the last few years. And in fact, this has been one of the lowest growth rates when we do look at it from the 10-year basis, and this is still below what management are targeting moving forwards. And even with that at 384, when we do run it through the MOS at 10%, pretty much a buy if you believe that it meets that 3 criteria, if you believe it has a wide moat, strong financial metrics, and good forward-looking data. If you want a bit more, then really it isn't a buy now. 15% you'd have to wait for 326, at 20 around 327, and at 25 around 288. So it could be one that if you are considering to buy, it may be worth waiting until we see a larger MOS. And if it is one you already hold, probably not one to sell just now, as it still does look undervalued, although fairly marginal. In terms of Wall Street though, they see very minimal upside, price target of 351 at 3%. So maybe you could argue that the insider, as we saw today, the CEO, has been selling this because he has the knowledge, and maybe he also believes that for right now, this is one of the highest we will see for this company moving forwards. The next stock we are looking at is BlackRock, where in fact the senior managing director a few days ago did sell around 10.5 million worth of shares. On top of that, we also note here again another sale from the same managing director for another $10 million, so that is quite a significant amount. When we take a look at the actual company itself, it does trade at right there at the upper end of the 52-week range with a buy, but only from Wall Street, a yield of 2.34%, and in terms of a forward P around 21. Now, good performance over the last 12 months, up 29%. Over the last 10 years, again, significant outperformance of the S&P, up 163. But we do note here, in fact, November 2021, all-time highs around $970. Now, in terms of dividend safety, 98, very safe, so that is good to note. But they only increased the dividend by 2% this January, which, as you are aware, that is below the 4% inflationary rate we do want to see on the channel. Now, it was reaffirmed last month, their dividend safety score, and this just means that a dividend cut for BlackRock is highly unlikely. Now, this is the key metrics from the last recession, in fact, the great 07-09 recession. Now, they maintained the dividend, they didn't increase it, but they also didn't cut it. They had negative 23% recession sales, which was below the average, in fact, which sat at negative 12, and they marginally outperformed the S&P, negative 50, with the S&P's negative 55. As we said, very poor increase just this year. However, over the last 5 and last 20 years, we have seen some incredible double-digit growth, one of the reasons why we were very disappointed. And we can see they have been increasing those dividends for the last 14 years. Now, in terms of dividend yield theory, for maybe those that are new to the channel, it states the company is undervalued when the current yield sits above the 5-year average. So right now, we have an argument here for overvaluation. And on the forward PE, you could argue reasonable valuation, as the forward PE isn't too dissimilar from the 5-year 20 versus 19. We do, however, note the financial sector as a whole does sit much lower at 11.9, but you could argue within this bucket of companies, there are a lot of low-quality companies, and in fact, BlackRock may be one of the higher quality inside. As always, though, we can find that out as we look at the metrics. Free cash flow payout, where we want to see below 50% for asset managers. Now, it hasn't really been around the level we want to see, probably why in 2023 at the 78% level, we did see a very mediocre increase, but over the next 12 months, it is anticipated to come down to around that 44% level, so hopefully moving forwards, we can go back to the double digits we have come to love with BLK. Free cash flow per share now very inconsistent. It has been increasing over the longer term, but don't expect massive increases. And we do note over the next 12 months, it is anticipated to increase to around 46.10. But again, as always, we will need to revisit this on a quarter-on-quarter basis. Then when we get to sales growth, 3 to 7%, we note the last 2 years have been very poor, negative 8 in 2022, flat over the last full year. 8% on a trailing 12 months, so possibly moving forwards, 2024's full year could be a lot more positive for BlackRock. We also note some strong growth to their top line over the longer period, 11 billion to 18, and they do some share buybacks, returning excess cash as we can see, but it is fairly trivial over the longer term. But as we do state from time to time, it is a bit of an added bonus, as it does give you a larger portion of control of the company you hold. Now, ROIC, we do want to see around 25% or more for asset managers, so a little bit disappointing, but granted, we do see the consistency on a year-on-year basis around the 12 to 15% point. point. And then when we look at the operating margin, we see it well above the minimums at that 25%. Has been decreasing, so not something we ideally want to note from companies. And the free cash flow margin above 20% does straddle around that. So typical with a lot of companies we do look at, free cash flow doesn't seem to be something they are struggling with. Operating margin as well, not an issue, but we do want to note some nice operating efficiencies. Net debt to EBITDA as well, below 1.5 for asset managers. So this number does change when we look at the different industries and we want to be more specific. 0.15 in 23, 0.19 over the next 12 months. Very strong balance sheet, no worries. Hence why we saw that 98 very safe dividend score. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $874 is the average of these three models. When we do our deeper dives, we do run through every single one. For BlackRock, we'll just get straight into it. Now, what we're pretty much saying here is, given the current price of $871, we believe this is trading at its fair value. Now, Wall Street don't agree. They have a price target marginally higher at 931 with 7% upside. But if we are new to this company, we're considering adding it. Right now isn't the place that we would be looking. 10% MOS, well, a buy at 787, 15% around 743, and ideally we would be waiting for at least a 20% around the $700 mark. So today's episode for BlackRock, we do note around $20 million worth of insider sales, and we can see that this isn't one that we would consider currently, and Wall Street also only give it some very mediocre 7% upside. The next company we're looking at is Fortinet, with the president and CEO selling around $3.5 million worth of shares. Now, when we look at this company, it does trade pretty much now at its all-time 52-week high as well. Now, this is a strong buy from Quant, incredibly rare to see. A buy from Wall Street with a hold from Seeking Alpha. Another one that doesn't pay dividends with a 36.5 PE ratio on a forward basis, up 28% over the last year. Over the last 10 years, significant outperformance again, up 1,373%. Now, no dividends, so in terms of the free cash flow, this is very, very nice to note. This is the constant increases that we are talking about that we get to see, expected to continue over the next 12 months as well for Fortinet. And when we look at the sales growth, it continues with a double-digit increase on a year-on-year basis. May start to slow down given the trailing 12-month, but again, this is something we can look at management's investor presentations to see their guidance for the full year as well as the next quarter. So this growth translates to around $770 million in 2014, going up to $5.3 billion in 2023. And even though their share return has been incredible over the last 10 years, they've also managed to do some share buybacks over the position. Again, fairly minimal, but nonetheless, always very, very great to see. And this is probably incredible ROIC. In fact, I'm going to say this might be the best we have seen on the channel. 203% in 2023. Trailing 12-month basis, still showing a triple-digit point at 106. Love to see that. That is something that we would say is incredibly rare, and you probably will only see this once or twice when we do review companies on the channel. Operating margin as well, absolutely gorgeous. Yes, it has been very low, 2015 at 2%, but look at that operating efficiency every single year. Whilst they are increasing their top line, they also increase their margins. Free cash flow as well, consistently very, very good. We finally get to the net debt to EBITDA. I mean, absolutely beautiful. Zero right across the board. It won't even take this company one day to pay off all of their debt net of cash on hand. Now, for a company that has some incredible metrics, we do know the intrinsic value today at $76, pretty much in line with the current price. So very similar to the previous company, BlackRock. We do believe Fortinet is trading at fair value. Wall Street, in fact, have a price target of $71, giving it a downside of 5% over the next year. Now, if this is one we were looking to buy, again, 10% a buy at $68, 15% at $64, 20% around $60, which is probably where we would say it would look very, very attractive. But right now, trading at its fair value, and as we just saw, some insider notable selling. Now, before we move on to the final stock, just to let you know, we have released our latest free weekly article where we run through some super investors, what they've bought, what they've sold. We've also got a lot of other articles that you can read free and instant. And for those that are interested, we have also released our 35 undervalued stocks for the month of August for your consideration, where we also also run through those that sit within our own portfolio, so do check that out by clicking below. Then finally, we are looking at Nike today, where the executive chairman has sold around $4 million worth of shares. Now, this is a company that just recently Bill Ackman did disclose in his 13F. You would have noticed that if you did read our free weekly newsletter from this morning. And what we can see, it is down around 22%, but just over the last 5 days, it is up around 7%. Over the last 10 years, we do note up around 112, although we can see all-time highs November the 1st, 2021 at just under $180. Now, it does trade in the mid to lower end of the 52-week range, a double buy rating with a hold from Quant, a yield of 1.78% and a forward P sitting above 26. Now, in terms of dividend safety, the highest score obtainable at 99, and we also note a nice high single-digit increase of 8.8% in November last year. Now, in terms of the last recession, how did they perform? Well, they increased the dividend, they had above average growth, and they also significantly outperformed the S&P, negative 36%. And we also do love their growth as a dividend company, 11% over the last 5, 15% over the last 20, and we can see 22 years of consecutive increases, meaning they are 3 years away from gaining dividend aristocrat status. Now, when we look at dividend yield theory, a severe double undervaluation signal both on the yield and the forward PE. When we do look at, though, at the consumer discretionary, the sector as a whole does sit significantly lower at 13.6. Now, free cash flow payout pretty much below 60% every single year, 33 in 2024, so no surprises why this has always been a very strong dividend growth company. And in terms of the free cash flow, whilst we do note inconsistencies on a year-on-year, doubled over the last 10 years, but we do need to point out over the next 12 months, free cash flow is anticipated to drop. In terms of sales growth, again, over the longer term, yes, it does look good. We can justify that COVID drop, but do also note over the last full year accounts, 0%, so their top line has been flat. And from a numerical standpoint, it has gone from around 31 billion in 2015 to 51 in 2024. They've also done some share buybacks, again, not very consistent. In fact, some years they've done some share issuances. Over the longer term, though, net position share buybacks, and again, it is just a little bit of a bonus. In terms of the ROIC then, well above that minimum 10% we want to see, just the last 4 years alone in the mid-20s. And when we do take a look at the margins, both operating, we see it above the 12% for the majority of the years, straddling around that level to be fair, and the free cash flow pretty much the same, although it looks to be better, especially over the last few years, in the 10 to 14% point. We then finally get to the net debt to EBITDA, well below 3 over the last 10 years, 0.05 in 2024, 0.06 over the next 12 months. No surprises whatsoever why this company does effectively have a very safe dividend score. Now, the intrinsic value at $95 is not dissimilar from Wall Street's 93, where they see upside of 12%. And when we do run it through our MOS calculation, at the 10% level, it is a buy at around $86. At 15%, it isn't quite there yet at 81, so we would say in today's episode, somewhere between the 10 to 15% point. As always, though, do give us your thoughts below. Are you adding to any of these? Maybe insider selling is something you do consider. In our opinion, though, as we did say earlier on, we wouldn't necessarily consider a bearish signal. Insider sell for many reasons, whether it's personal or financial, but it is always good just to keep on top of what insiders doing, both in terms of a selling perspective as well as a buying, which we do consider to be a very bullish signal, as ultimately insiders do buy because they believe the share price will go up. As always, though, drop your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And don't forget to sign up to the free weekly newsletter below. Grab a copy of the more recent one that we just dropped this morning. And don't forget to come and join us in the Patreon if you do want to discuss our weekly buys and sells. As always, have a great day and we'll see you all on the next one.